The day has finally arrived. The trade deal has been signed. Prosperity is abundant. Everything is resolved. Peace is restored. Love is in the air. Right. Well, instead of reading tweets or news headlines, wouldn't it make more sense to read the trade agreement and try to acknowledge what's happening for yourself? Of course it would, but 99.9% of the people who even know about the trade agreement will not even dare glance at it. It's an embarrassment and unfortunately does absolutely nothing to resolve the issues between the two countries. Not a single thing. It's sure better than nothing, but please don't believe the lies that this is in any way a deal. It really isn't. You came here for the truth, so let me unveil that for you. Today we're going to talk about the trade deal. I also want to talk about what's happening in the financial system, particularly with the Fed. I'm going to show you what the Fed President Kaplan had to say. I think it's really important because it shows us what has been happening, how this has all been a result of the Federal Reserve's own policies. But first I want to look at the trade agreement. This is the actual document. Don't go to the CNBC article and get the little snippet. Don't go out there and try to get what you think is real information from tweets. My goodness, please don't do that. Go to the actual ustr.gov website and read it for yourself. Now, it's long. I actually only made it about approximately 50% of the way through it, the rest of it being, the appendix and all that. When you look at this, it is big. It is full of legalese. It's full of all this jargon that a lot of people just aren't going to get. And certainly it was not an interesting read. I fell asleep multiple times going through it, actually. But when you look at this information here, you are going to see the fact that it isn't a deal. I want to make that known right now. It's not a deal. There's nothing enforceable about it. And basically what they're saying is we're putting this stuff on paper and we're going to figure everything out later. You read it for yourself. You tell me what it says. If you disagree with me, please. But if you actually read the document, I'm providing it here, source and description. If you want to check it out, you will see that. There's nothing enforceable about it. It's actually not a deal. And they said they did this on purpose so they wouldn't have to go through Congress. But just look at it. It doesn't really do anything other than suggest that China has to buy agriculture and the rest of it is basically pushed off into the future. Yes, they do talk about the fact that, China wants this to happen within a 30-day period. The US wants this to happen within a 30-day period. But there's really nothing there to make this a trade deal in that sense. So I thought it was interesting, looking at the details that you see in CNBC, that you see in Bloomberg. You get charts like this. China agrees to purchase $200 billion of US exports under the Phase 1 deal signed in January. China will buy an additional $200 billion US goods over 2 years. This is the breakdown. I will give you the actual document. You see this in the media all the time. Why aren't they just showing you what's in the document? This is it right here. Annex 6.1. This is the actual chart you need to see. Yes, it might contain the same information, but why not go to the source and get it? Why didn't they just take a screenshot and show you this? They like to put it in their pretty little page instead of giving you the real deal because you never really know. You can't actually trust them. So we want to see this and we want to look at it from the source. Well, of course, you could see that China is intending on buying more agriculture, among other things. What I wanted to note in here was that there was this mass confusion in the mainstream media. They were first talking about the fact that it was going to be $40 billion, then it was $50 billion, then it went back to $40 billion. There was some argument about the numbers there. And then we noted here that it's on top of 2017's baseline. You could see on the right-hand side, additional US exports to China on top of the 2017 baseline. Year one for agriculture is 12.5, and then year two being 19.5. So the 2-year total is 32. But when we got those numbers, the 40 billion, the 50 billion, was that supposed to be on top of the 2017 numbers? It really wasn't clear. But anyway, this is what they're saying. This is what they put on paper. We'll see if it actually even happens. I'm going to be paying close attention to it. Obviously, I'll bring you that data, but this is it directly from the source. The Little Munchkin says that more tariffs will be rolled back in phase 2 of the trade deal, and what I found to be actually hilarious, I burst out in laughter when I saw this one. Just as in this deal, there were certain rollbacks, in phase 2, there will be additional rollbacks, he said, and we have said before, phase 2 may be a 2A, 2B, and 2C. So we've got optimism, trade optimism in the headlines for the next foreseeable, several years. We're going to be seeing trade trade optimism, trade optimism, trade optimism, because now we're going to be going for that 2A trade deal, okay, 2B trade deal, and then why not? Let's get into the 3As and the 4As, and let's just go down the list. For the next 100 years, they're going to be working out this trade deal, and then eventually we'll get to one. Honestly, it's ridiculous the way that they do this. Now, I want to say, again, as I said in the introduction, if they are making progress, if they are talking, if they are shaking hands, this is a good thing. I am not opposed to that. But don't call it a deal. Please don't call it a deal. Don't call it an agreement. Say that you came to some conclusions about some things. There is progress being made. That's it. That's all you got to do. But they don't want that. They're trying to put this out into the media because they're trying to maintain the strength of their economies. They're trying to grow, not shrink. There's a contraction happening globally, and they're trying to prevent that, or at least slow that down, not exacerbate the problems. Anyway, they even said it here in CNBC. I noticed some of the articles started pointing to the fact that, well, it's not exactly what we were hoping for. The Phase 1 deal is seen as sort of a truce and includes concessions by the Chinese to crack down on intellectual property theft and the forced transfer of American technologies. From what I glanced over as I was reading through the document, it doesn't actually push anything. It doesn't make things happen. It just puts them on paper. China recognizes that they will need to do this, this, and this. But there's absolutely no details. It doesn't go into any level of description on that. It simply states it on paper. Yeah, that's a good thing, but we're nowhere near where we need to be, even though it has been 18 months since this formally and technically began. Before I move on to the next subject here, this is a couple points that they make, but if you actually read the agreement or the deal or whatever the hell you want to call it, they're making it seem much better than it is. So these points here, all of them that they're covering here, if you go into that document and try to just skim over some of these, you'll see that it's not so positive as they make it seem. Check it out for yourself. I'll leave that up to you. If you do happen to read it or any of it, definitely post your comments down below and I'll read through them. I'll try to reply as many as I can. Let's get a conversation going about it. I want to know what you think too. It didn't take me that long to move through it because of course a lot of it is just that legal jargon. So if you're up for it, definitely check it out. Now I want to look at what's happening, of course, with the Fed. And that brings me to the next subject for today. Northman Trader had this to say: spurred by low interest rates and loose financial conditions, we know who provides that loose monetary policy. We estimate that total global debt will exceed $257 trillion in the first quarter of 2020. A total of more than $19 trillion of syndicated loans and bonds will mature in 2020. The amount of debt right now today is absolutely staggering, and this comes in the form of national debt, corporate debt, and you look at the average individual, whether it's coming from their student debt or maybe their credit card debt. I posted on the community or blog section of my channel today talking about the fact that people right now are still paying off their holiday purchases from 2018. So a year later, they're still paying off the debt, carrying that through on their credit cards at 17% interest. Is that a healthy economy? Is that strong? I really don't think so. The New York Fed is basically giving big banks a subsidy with its ongoing repo operations because its rate is below the market's rate. Very interesting, and something that I've been talking about here as this has been going on since September. This has been a backdoor bailout, not just at the hedge funds as I talked about in yesterday's video, but we're looking at this on all levels right now. It's not good. The Fed's Kaplan has been one of those that has actually acknowledged somewhat of what the Federal Reserve is really up to. There's a couple points in here. First, interest rates are lower as a result of the central bank's 3 rate cuts in 2019, he said. Secondly, investors have the perception that the bar is higher for future rate hikes. I don't know if I completely agree with that, he added. The third issue is that the Fed has grown its balance sheet to quell turmoil in the short-term money market. I'm conscious all three of those actions are contributing to elevated risk asset valuations, and I think we ought to be sensitive to that at the FOMC, and I certainly am. So we have one individual speaking up about it, how the fact that we pump money into the system, whether it's QE4, whether it's QE3 or any of the others that they've done, and what does that do? The markets go higher because people see this as an incentive to keep putting money in. We see a devaluation of the currency, and of course we see the asset prices rising. Of course, investors follow this. They look at every single thing the Federal Reserve is saying and they invest based on that. The Federal Reserve has to acknowledge that. We get some small admission here, but look at this in the broader context of what has been happening all of these years. The Federal Reserve has generated what has happened. Of course, not just the Fed, the central banks around the world, they have been generating all of the madness we've been seeing. This is the article out of Bloomberg itself, and essentially there are a couple points in here that I wanted to touch on. The font is really small, but I need to get the points at both the top and the bottom. I'll cover it quickly. Right here it says, Kaplan's views contrast with those of many of his colleagues who insist the Fed's resumption of purchases of assets is a technical change that has little or no effect on the value of asset prices. You know what Powell said, this is not QE, and so on. However, at the bottom, it is really important to note, my own view is it's having some effect on risk assets. It's a derivative of QE. When we buy bills and we inject more liquidity, it affects risk assets. This is why I say growth in the balance sheet is not free. There is a cost to it. I can't believe it. We have the Federal Reserve's own admissions echoing what I have been saying all of these years. And it's really good to see it coming from this source, directly from the horse's mouth. This is a Fed president, and he has said a few things over the last little while that I'm actually really happy to see. Now, does that change anything? Does that mean anything necessarily in the markets tomorrow when they open? Of course not. But it feels really good to read this kind of info, knowing it supports what we've been saying all along. Now look at the risk that's been going on today. Proportion of US IPOs that are loss-making at the same level as the dot-com boom and bust. And people laughed at this. People were saying how ridiculous the valuations of the dot-com bubble were, and it is a joke, and it will never get back to that level. It was crazy. It was stupid. We're more prudent. We're more reserved today. But unfortunately, we've surpassed it, and they say the same thing they did back then. Oh, well, this time is different. No, it's not. Yes, there are some differences, but when you really look at it, it's the same things that happen over and over and over again. All of the things that we should be paying attention to are ignored. That's just the way it is. Money-losing propositions, far more small companies are persistently loss-making. It just gives you a breakdown on this chart. As time goes on, we tend to forget about history and just go further and further away from reality. The Russell 1000 growth versus value actually going way, way beyond what we saw during the financial crisis and, of course, the dot-com boom. Sure, you might not see necessarily, let's say, PE ratios or something else for a particular stock going to the levels that you saw back in 2000, but that's not really what it's saying. It's that there is excessive risk taking right now, coming at a time when the market has just, been really stretched. Nobody wants to believe it. Nobody wants to look at this, but even the Fed's Kaplan has actually pointed to it, and I'm so happy to see that. Let me know what you think of this video, particularly with the trade deal. If anybody wants to spend a few minutes to read through this trade deal, skim through it, give it a look. I really want to know what your thoughts are on it. Link will be in the description. That's all for this video. If you found that informative, hit the like button. I want you to go out there and find other resources of people that have actually read the trade deal, that actually go in to find the sources of information for you to bring it to you. Unfortunately, very, very few do. If you appreciate this work, click the like button. If you want to know how to make money on the side, if you want to know how to replace your 9-to-5 income, this is the best place to start. It's free. I created an e-course teaching you how to sell on Amazon, teaching you about e-commerce. Check it out, theamazongps.com. If you want to know about the financial system, about how to make money, the foundation, the history, everything, it's all located in these two books here. The link is in the description. If you want the audiobook, themoneygps.com. Wait a second, hang on there. Have you seen this video? Really, really good stuff in here. I want you to watch it if you haven't already. Click on it and I'll see you there.